Most people think that the bank is the safest place to keep their money. But what most people don't realize that keeping excess money in the bank is probably the worst place to have it at. Today, I want to give you 4 ideas going from the easiest to the hardest so you can put your money so it can work better for you. And be sure to stay to number 4. That is the best idea that will make you the most rate of return on your money. The first one is certificates of deposits, or normally called CDs. So CDs or certificates of deposit are just like a step up from a bank account. You open one up and the interest is going to change according to the time that you put that money in that account. So let's assume that you put in $50,000 and you're earning, let's say, 5% a year. You will make $2,500 by the end of that year. This, again, is just like a bank account. You keep the money in the bank account for that year, you earn your 5%. If you break the timing, you will have penalties. So it's always good to remember, when you commit that money, whatever amount of money, try to leave it there for the amount of time that that CD is calling for. CDs are for short-term safety. They don't really do a lot for you. They give you that 5% at the end of the year, whatever it may be. They are not for long-term wealth, but it's a good start. The next option is index funds. Basically, what is an index fund? An index fund is you invest in an account that they invest in tons of companies all over the place. And your money is going to be invested evenly across. Let's say that you put $10,000 in a savings account, and most banks are going to pay you no more than about 1%. You leave these $10,000 in the bank account for about 20 years. After 20 years, you are going to have $12,200 in interest. Now, you put the same $10,000 in an index fund, which averages about 8%. Over the course of 20 years, you will have earned interest of $46,000. Big difference than just a regular bank account. Index funds are going to beat inflation over time. They are basically long-term investments. They are being invested in stock across multiple companies. They are going to be long-term. You need to remember, long-term is going to make the most and is going to be those up and downs in the market. Next step up, retirement accounts. 401ks, simple IRAs, Roth IRAs, and there's many others. And this is so important. This will give you even a higher rate of return than even index funds because of their tax benefits. So let's start with a traditional 401k. Most employers will offer a 401k. Let's assume that you're making $150,000 a year. You take $20,000 and you put into a 401k. That $20,000, if you are in, let's say, in the 30% tax bracket, just made you $6,000 that you do not have to pay in taxes right off the bat. $6,000 on $20,000. Where can you earn that? I really like this particular investment, especially because it's long term and because in the end you will be able to take this money out and/or you can borrow against most 401ks and pay yourself interest if you have a plan that allows you to, which most do. Now keep in mind, with a 401k, when you retire and you plan correctly, you will be paying income tax. Now let's go to an after-tax retirement account, such as a Roth IRA. Let's assume that you put $7,000 every year for the next 30 years. That is total contributions of about $210,000 over the course of 30 years. Now, this is normally going to grow to about $600,000. And every dollar that you take out from a Roth IRA is tax-free. Now, compare that to a bank. No tax deduction, no free tax growth, and no compounding advantage. Bottom line, retirement accounts, they work for you. They save you in taxes. They compound that money long term, so you can even borrow against some of these accounts and pay yourself back interest. And the best benefit of all is they set you up for retirement. Option 4 is real estate. The thing with real estate, it requires more work. And obviously you get paid when you do more work. It's just a no-brainer there. The work is where you buy the property, you gotta finance it, you've gotta do some maintenance and management. But the rate of returns on real estate are usually very high compared to any bank, index funds, and sometimes even retirement accounts. So let's assume you buy a property for $300,000. You put $60,000 down. You rent it for about $2,500 a month. Now, by the time you pay all your expenses, the mortgage, interest, insurance, HOA, your expenses are about $1,800 a month. Now, your cash flow every month is going to be about $700. So roughly about $8,400 a year. This same home normally would appreciate about $9,000, which is roughly about 3% every year. And now you're also getting your loan paid by your tenants. That's another $4,000. That's your earning. It's growing. Doesn't seem that way, but it is. A lot of people don't even realize that once we take depreciation, we normally don't pay any income on most of rental properties. So here's what's happening. Your total annual benefit, when we add all those benefits I just listed, is roughly about $21,000 over a $60,000 investment you just made on a property. That is about 35% rate of return. Try getting that from a bank or any of the other investments, like basically in the first year. This is the reason why this is my favorite one. While it's not perfect, we've seen the different crashes of 2008, but real estate has maintained itself very consistent, very constant. And after all, everyone needs a home to live in. Bottom line, real estate requires some extra effort, but the rates of return are much better than most of the other investments that I've talked to you about, and definitely much better than any bank will ever make you feel safe. And I really hope what I have discussed makes you realize how your money is not that safe in that bank. Keep all your excess money in different investments and definitely always diversify. Your money you've put away should be working for you. Keep a fund of at least 3 months of your regular expenses. The rest, let it work for you. If you like this video, like and subscribe. Leave us a comment in the comments below, and we will see you next time.